And before we get into this, we'd like to remind you, please like, share, subscribe. Your support is appreciated, especially as we go into year end, trying to get as many subscribers as we can. So again, your support is appreciated. Now, one of the things that I could do a whole course on the Taylor rule and what does it mean and why should we either ignore it or look at it, because you can make a case for both. And I just think it's important to look at it to say, well, where should the rate be? And this is looking at the Fed funds rate and what the baseline Taylor rule estimates the Fed funds rate should be, which right now, as you can see, is 7.6%. And it's the highest it should be if you go back through 1993. So just when you think about it in simplistic terms, so what is the equation saying? And it's just saying that the Fed will adjust its Fed funds rate target by an equally weighted average of the gap between actual inflation and the Fed's desired inflation, which, as we know, is around 2%. And then you factor that into the gap between observed real GDP and hypothetical target GDP. And that's when you keep it at that consistent linear growth rate, which when you look at Taylor, what Professor Taylor did, or Dr. Taylor should say, calculated 2.2% from 1984 to 1992. So trying to just, and again, this is just a gauge. This isn't like, oh, they should be sitting there at over 7%, but it just gives you an idea of just how offsides the Fed currently is and why they're starting to drop the talk of inflation. And now you're starting to see some of these different shifts. And this means that the Fed will raise its target Fed funds rate when inflation rises above 2% or real GDP growth rises above 2.2%, and they lower the target when that reverses. So what does this come to? And it's just using an econometric model describing the relationship between Federal Reserve operating targets and the rate of inflation and gross domestic product. So it's trying to just link them together to figure out, what should they be doing? And I think this is much better in terms of where is the trend? Where is the trend? And you can see that the trend is obviously up in the rate rising cycle side, but the pace of it is accelerating. And I think that's the biggest concern, is the accelerating move higher based on the inflation side, because we do see GDP slowing, so that is going to soften some of this in terms of where GDP is in general. But you're getting an idea of just how elevated things are and how they are going to try to get in front of that. And that's why we think the pace of these increases, again, remains elevated. The rate of inflation grows has been interpreted both as a way to forecast Fed monetary policy and as a fixed rule policy to guide monetary policy in response to changes in economic conditions. And that's where we continue to see some of these shifts, as we saw yesterday. So what do we have? The number of participants reporting weighted upside risk to core PCE is at 15. So you can see that most of the individuals involved in the Fed see a huge increase in inflation, which I guess if you'd have to be asleep at the wheel to not think that. But one of the key things, so what are some of the key takeaways from the FOMC meeting? So taper accelerated. And I think that's a big piece, again, speaking back to the Taylor rule. So a reduction in the pace of asset purchases by 20 billion versus the 10 billion prior in treasuries, and 10 billion in mortgage-backed securities was previously 5. So we're going to get a total of 30 billion taper. And that's going to be 20 billion treasuries, 10 billion mortgage-backed securities, or MBS, with the wind down concluding in March of 2022. So that's really an acceleration point. They also have gotten rid of transitory, as describing inflation. Supply and demand imbalances related to the pandemic and the reopening of the economy have continued to contribute to elevated levels of inflation. And again, the reopening of the economy, I think, remains a crutch, and you're going to see a lot of this give way where it's, supply demand imbalances. It's going to be wages. Wages is going to be that sticking point as this inflationary pressure continues to grind higher. PCE inflation forecast for 2021 revised sharply up. Headline inflation was raised to 5.3% from 4.2%, and the core to 4.4% from 3.7%. And then they expect inflation to slow inflation beyond 2021 to slow significantly, though not to the degree previously. And that's, I think, the big piece. Now they're expecting 2022 to be 2.6% versus 2.2%. and core to be 2.7% versus 2.3%. Again, we think it's going to be higher. It will slow, as we've been saying, but again, that stagflation is going to keep us at that elevated level of well over what we're seeing of 4%. The unemployment rate is expected to drop, and again, that's going to remain low, which is why I think the employment side getting better is going to help incentivize them to do less. And then the dot plot, as we'll discuss coming up, given the forecast revisions, they see 3 rate hikes, which again, as for anybody who's been paying attention to what we've been saying since the beginning of this year, we believe 3 rate hikes was always going to happen in 2022, and here we are. In general, so 3 rate hikes for next year, 3 for 2023, and 2 for 2024. Again, we think that that's very stable. The plot suggests a more hawkish shift, which again is not surprising, as 8 of 18 participants anticipate 4 or more rate hikes in 2023. Why did the market rally if this was, I think, the expectation? And there's a view in the market that the Fed is going to panic and not do what I just outlined. The view is that they're making a policy error, and that policy error will be reversed next year, which just means that they're going to taper. I think the tapering is not the concern. It's the Fed funds rate. There is a growing view that there's only going to be one, and if there is 2, there's actually going to be a cut. And I think that's incorrect. That's personal. I've gone through why I think that's the case, because I don't think the Fed has many options at this point, but to start to raise rates more aggressively because they've waited too long. But again, that's why we've had this big reversal higher, with the idea that this is not going to stick, that this is going to be a policy error, and you're going to see them become more dovish and not follow through on their hawkish stance. But now when we look at the anticipated steeper path of rate hikes, this just gives you an idea of where the expectations are. So the December dot, you can see just how aggressive that move is up through 2021, and obviously it through 2022, and how by the end of 2024, we'll be sitting at 2.5%. Again, that's really not that high, which my whole thing is that it's going to accelerate forward, but you can clearly see that the market disagrees. So then when you look at the inflation forecast, this gives you an idea of where the expectations are and how that is shifted up. We just expect 22 and 23 to continue to move up. 22 will be over 3%, and realistically, 23 will be much closer to 3% by the time we get through Q2 of next year. So then when we start looking at, well, why? And it's funny because going into this meeting, the hawkish central bank now is the biggest tail risk since May of 2018. So when you look at the hawkish central bank, so this is looking at fund manager surveys, and when you look into, as of December, what is the biggest risk to the market? And when you look at it, everyone has responded with either a hawkish Fed or inflation. But yet we got a hawkish Fed, and the market went up. So nobody's willing to believe that the Fed is going to follow through with their current backdrop. And that's where we do disagree with the market, that we do think that they have no choice, but will have to follow through. So here's another reason why. So the Fed reverse repo facility set a new record of $1.621 trillion. As we've been saying nonstop, and as we go into year end, we're positioned to take out $1.8 trillion. And it's just, there is a ton of liquidity in the market. There's a ton of slack, and a lot of this is going to have to start coming out as M2 has just exploded, and we need to pull out some of this liquidity over the near term. But at the same time, and again, this is speaking back to the Taylor rule, the expectations for GDP has come down. As we were saying previously, it was too high. We're still below 6% for Q4, and we think that we'll get there fairly quickly as we get some of the early December data in terms of the leading indicators that will again continue to pull us below that 6%. Now, when we just look at a brief overview of economic data points, I'll pull some out. We're going to go through them in a bit more detail. As we said on Friday, CPI was slightly above expectations. That continues to be a problem. We'll talk about that in a minute. Real average hourly earnings had a big drop, was negative 1.9%. We see that being continuing to be a problem in December as inflation still remains elevated. University of Michigan expectations slightly better than expected. Again, that's a positive. But then small business optimism right in line. PPI, though, again, leading indicator for where CPI is going to be, PPI just blew it out of the water. Expectations were for 0.5%. They came in at 0.8. Then when you take everything, again, everything was above estimates, well above estimates, with more pressure to the upside. PPI final demand year over year was expected at 9.2%, came in at 9.6%. Again, all of this is just driving higher, which is just going to continue to feed down into CPI. But it doesn't have to do it. It's not like, oh, it's up in November. It's going to, CPI is going to be up in December. There's a time delay. There's, how much can you push through? What can the consumer handle? What is the cost of your inventory? It's not just a direct, it's just you're getting an idea of the direction of this. And this is just showing how their companies will try to recoup some of this cost. And again, that PPI remains the biggest problem as we go forward. And it's happening everywhere, as we showed on Friday. PPI around the world is continuing to ratchet up, and the U.S. is in the same boat. Now, when we look at retail sales, again, retail sales, big swing and a miss. When the estimates were for 0.8, they came in at 0.3%. And then when you look at the control group, the estimates were for 0.7, and we actually had negative 0.1%. So if you remember, we were saying that October was going to see so we thought September weak, October really strong, November weak, December weak. And instead we got September strong, October strong like we were expecting, and then November we got the number that we were expecting. And again, this is something that we think is going to continue and bleed into December as well. And then when you look at pricing, again, feeding into the slowing retail sales will help counter some of that, because you're starting to see people say, look, I can't afford this now. Like we're getting to a point of friction in terms of what can the consumer tolerate? What is the pricing in general? And now when you look at import prices were up above estimates. They were expected at 0.6, came in at 0.7. Year over year, they were expected 11.4, came in at 11.7. Export prices were expected at 0.5, came in at 1%. So again, just inflationary trends and price increases happening around the board, across the world. Business inventory slightly up. We see that expanding just a bit. Then export price index year over year is at 18.2%. Again, very problematic, if you will. Then when you look at initial jobless claims, expected at 200, came in at 206%. So still everything moving in the right direction from the job side, which is, again, another supporting point for the Fed to continue to move down their more hawkish route, if you will. Building permits were up. Housing starts were up, above estimates. Housing starts were expected at 3.1%, came in 11.8% year over year, month over month. Philadelphia outlook was expected at 29.1, came in at 15.4. Empire manufacturing was expected at 25, came in at 31.9. So still, some good, some bad mixed in that. Industrial production slightly below estimates at 0.5. But then when we look at PMI, so PMI from manufacturing PMI was expected at 58.5, came in at 57.8. Services was expected at 58.8, came in at 57.5, bringing the composite down to 56.9. And all of this is consistent with what we've been saying about that perpetual, decline, where you're seeing that slowdown, and it's going to continue to accelerate into December. Again, still staying above 50, still staying above in a growth territory, but you're starting to see some of that acceleration to the downside. And this is when you just look at what that acceleration looks like. Again, you can see the slope is changing, and when you look at the preliminary. It was expected 57.2, came in at 56.9. And the overall new orders were still strong, but alongside ongoing price increases, export orders rose as well. So the export orders was good, but you still have strong new orders, but price increases are still there. And that's, even though some of this is slowing, which is indicative of maybe a little bit softer GDP, you're still getting those prices remaining elevated, which again is leading into that stagflationary backdrop. So then when you look at industrial production, November was in 0.5% versus the estimate of 0.6%. The level is now at the highest in September of 2019. So again, you're still seeing the new orders. You still have the backlog. So there's still reasons to see the industrial side remaining elevated. We just think that this is going to roll over a bit, but not like fall from 102.3 to 100 in a straight line. You're going to see a pause and you're going to see that round out. And we think that you'll see this start to pull back as we progress into Q1. So then when we start just looking at all of the CPI calcs together, core CPI obviously at 5%, and then if you shave it any different way, they're all in a very problematic area versus the target. And that's what we continue to see around across the globe on Atlanta Fed sticky, core PCE, market-based core. Again, all of these things are why we're seeing the Fed get more hawkish. And it's the sticky CPI, the one that's at 3.4%, because even as the flexible starts to roll over, starts to get better, that sticky is going to continue to drive up. All the while, wages continue to be bifurcated. The first quartile or the lowest earners continue to see their wages go up, but still not up enough to match with where inflation is, as we saw with real wages. And then the fourth quartile, or the people who are making the most, are seeing their wages continue to fall. So they're not even trying to keep up with inflation at this point, which again is going to dwindle some of that discretionary income for spending. But then when we start breaking this down, so let's look at some of these key pieces of PPI. So US PPI, processed goods for intermediate demand, was at 26.5% year over year, which is back to where we were in the early 70s. And that's PPI inflation for intermediate goods up 26.5% year over year in November, the sharpest rise since December 1974. So then when you look at the spread between CPI and PPI, it's declined to negative 6.5%, and it's the lowest since 1974. November's rise in PPI marked the 19th consecutive increase. While that is the highest since 1980s, it still has ways to go to match the prior record. So again, you're seeing a lot of these pressure points, and this is where we see a lot of why the Fed is getting so hawkish. And it's unlikely they're going to be able to deviate from the current plan that they've outlaid. Inflation soared again when you're looking at PPI final demand year over year. Then when you take PPI final demand less food and energy, you got another acceleration higher, which is what we said for November. We expect to see this slow down a bit in December, still be elevated, still be positive. But again, December, January, February, we expect to see some of this roll over. And then things start to accelerate again as we get into Q2 of 2022. Now, when we look at PPI and CPI together, you can just see where we sit. CPI at 6.8% year over year. You're just seeing how they're moving in a similar direction, which is why PPI and CPI, you have to, in our opinion, look at them together to understand where are we going. Rent inflation, again, this is going to be the biggest driver behind the CPI. Again, that stickiness that we've talked about. Rent inflation is moving in line with leading indicators, which are consistent with 4% plus by end of Q1 and 5% plus by end of Q2. Again, this is why we don't see this decline or this slowdown or this deflation as we go into 2022. U.S. real average weekly earnings continue to fall, and that's where we're coming back down. As we continue to see, it's based on what we've already seen so far, it's below the trend line at this point in terms of weekly earnings, and we're going to see those pressures continue to mount. And again, layer on the problems that we're seeing and the issues that are going to reside as we go through retail sales and economic growth through 2022. Because remember, the retail side is, I think, the retail is such a big part of the, consumption is such a big part of US GDP. And as we see that slow down, obviously a lot of things are going to slow in terms of just, inherent growth. So now when we look at import prices, because as we've been saying, we're going to be importing inflation, import price index by origin, all industries for China, from China, obviously through the roof. import price index, all imports excluding petroleum, again, just ratcheting back up higher. We don't see that adjusting. We see it pausing, like we don't see a huge surge up again, but we just see it holding these elevated levels. And again, putting that essentially floor in the CPI calc and inflation in general. And then U.S. core PPI year over year just gives you an idea of how that has gone, what the survey was, what actual was. We do see this slowing a bit, but you can just see that slowing a bit just means that we're still going to stay elevated. We're still going to be here, but it's going to start to just cap out and then go sideways from this point. As selling prices and goods across the supply chain are moving up, when you look at unprocessed, processed, finished, all of these pressure points are still remaining consistent as we look into December. With U.S. goods versus services inflation, all of them are moving up. Goods inflation we think gives way to more service inflation, so you're just going to see some of these lines start to converge. But when you look at just where they're going to converge from, it's still from very elevated levels, and we're not going to see too much of an adjustment. And when you break down the CPI calculation by the core, rent is a huge driver. That's continuing. When you look at some of the pieces, used vehicles is up there. That'll start to reverse. Rentals will start to reverse new vehicles. But when you look at apparel is up. Look at cotton prices, shipping prices. That's going to remain high. Other rent. So again, that's where we're going to get some of this level of stagflation as some of this becomes negative, some of it remains positive. And you see that backdrop as we go forward. And then the median consumer price index, again, trying to just shape it different ways possible. Going back through 2006, you can see at 3.5%, just how we're above where we were prior to the financial crash. And then 16% trim mean consumer price, you can see just blew through where we were in 2008, didn't even look back or pause. And that's where you start to see this give way of maybe this is much less transitory than we were expecting. And here's just another example of that costly protein, again, for people trying to buy food. You're seeing prices that are up anywhere from 10 to 25%. Again, then just based on what we're saying, we're not seeing that reverse anytime soon. And then when we look at initial jobless claims, just give you an idea of kind of where we sit. 4-week is the 4-week average is at the lowest since 1969. Again, why do we have rates where we are? Why do we have this easy policy just given where initial jobless claims are? And then when you look at the beverage curve, you get an idea of just how tight some of the market is in terms of the job opening rate and the unemployment rate. It's really the beverage curve is the highest it's ever been, again, indicating a change in policy. And when we look at job market search, it's starting to pick back up, because for those that have ever searched for a job, November, December is kind of terrible. And then things start to pick up as people get their bonuses, decide to quit in January, February, with really March seeing that acceleration. You're starting to get some of that tick up into the end of the year. And then when you look at the secular fall in GDP and labor force growth, this is where you start to get some of these pressure points with labor force participation and growth really not there, which is going to essentially drag down some of those GDP numbers and put a bit of a headwind in terms of where that's going to go going forward. And then when you look at the Philadelphia business outlook, you get an idea of kind of where some of these shifts are. But when we want to really touch on this again and build it into where retail sales are and what we think is going to happen, especially when we look into the next segment, which is looking at retail sales and the underlying consumer.